Welcome to this video on accounting depreciation for grade 9A. Our learning intentions today are to understand the meaning of depreciation, the methods of calculating it, and its causes. We will be successful if we are able to prepare various ledger accounts and the asset disposal account related to depreciation. Depreciation is the decrease or loss in value of a non-current asset over its useful life. It is a business expense charged to the income statement every year. The causes of depreciation include wear and tear from regular use. Other causes are erosion, rust, and decay due to natural elements or lack of maintenance, and obsolescence, which is becoming out of date compared to newer equipment. Further causes include inadequacy, when an asset is no longer suitable due to firm growth, time factors applicable to leased assets, and depletion, for wasting assets like mines, based on raw material extraction. One method is the straight line method, also known as the fixed installment or original cost method. Depreciation is calculated by dividing the asset's cost minus any residual value by the expected number of years of use. For example, if an asset costs $20,000 with a 5-year life and $2,000 residual value, the annual depreciation is calculated as seen here, resulting in $3,600 every year. The reducing balance method applies a fixed percentage to the reduced balance, which is the cost less depreciation already charged. This is applied to the original cost only in the first year. A question for practice is provided here. This slide shows a calculation example using the reducing balance method for an asset with a 10% depreciation rate for 3 years. The revaluation method calculates depreciation by comparing the opening and closing values of the asset. This method is suitable for assets that are difficult to value, such as small tools like screwdrivers or spanners. We review the reducing balance method again. A fixed percentage of the reduced balance is used, calculated on the original cost for the first year. Remember to practice the question provided. Here are 2 questions to practice the revaluation method. The first involves a single year calculation, and the second requires calculating depreciation when new loose tools are purchased during the year. This video covered the meaning, causes, and various methods of calculating depreciation. Remember to practice the exercises to fully grasp the concepts. When an asset is sold, the transaction is recorded in a separate asset disposal account. The next slides detail the required double entries for recording these transactions. First, transfer the asset's cost to the asset disposal account. Second, transfer the provision for depreciation to the asset disposal account. Third, record the cash or check received from the sale. The fourth entry records the profit on the sale of the asset, crediting the income statement account. The fifth entry records any loss on the sale, debiting the income statement account. Thank you for watching this video on accounting depreciation.